The London Stock Exchange is one of the oldest markets in the world with a long history that goes back to the coffee houses of the 17th century. Since then, it's become one of the largest in the world with over 2,400 companies being listed on its exchange. Making up the 100 largest of those companies is an index that was formed by the Financial Times and the London Stock Exchange Group as they combined together in 1984. Also known as the FTSE 100, or just commonly called the FTSE here in the UK, this index tracks the 100 largest companies according to market cap, so basically just the big boys. Within the FTSE 100 are some huge global international names, which I'm sure that even if you lived completely off-grid, you've heard of most of these, and you've probably been a customer either directly or indirectly at one point of your life. But wait, and that all sounds great and we love a good history lesson, but this video is all about whether the FTSE 100 is a good investment today, moving forward, not looking back. It's not typically an area that gets a lot of love on YouTube because most YouTubers in the finance space, of course, are based in the US, and they focus on the largest market quite rightly, and they talk a lot about the S&P 500, which of course is substantially bigger than this market, but that doesn't necessarily mean that it's better. And of course, as we know, past results cannot dictate future returns. So in this video, I thought I would show the FTSE 100 a little bit of love, a little bit of attention, look at some of the past performance, see if I can work out what this market might hold in the future, look at some of the individual companies that make it up, and try and work out if this is a good place to put our money and roughly how much of our money we may want to invest in this index. Remember, you should always do all of your own research, and I'm not a professional financial advisor, and even if I was and you tried to bribe me with chocolate, I still couldn't give you advice. But I'd take the chocolate anyway. Anyway, with that out of the way, let's get straight into the numbers and have a look at the FTSE 100 in all its glory. Okay, here's some high-level figures for you. So if we take the entire UK stock market, we get a figure of around £4.5 trillion total value, which in dollar terms translates to about $6.2 trillion. Quite a lot of wonga. For some added context, and just to put that into perspective, because it's really not as big as it might sound, that the FANG stocks out of the States, so that's Facebook, Apple, Amazon, Netflix, and Google, actually make up over $7 trillion worth of market cap. So the entire UK stock market with all of the companies listed doesn't even beat those 5 FANG stocks. However, with that being said, it's the 6th largest market in the world, the 2nd largest market in the US, and the UK still provides nearly 4% of the world's global output. But with that being said, let's narrow down our focus because today's video, we're really talking about the FTSE 100. So out of those amazing list of companies and that amazing list of growth that we've just spoken about, what about the 100 biggest winners in this list? So some of the largest companies that make up the FTSE 100 are the following. We've got AstraZeneca, Unilever, Diageo, HSBC, GlaxoSmithKline, Rio Tinto, British American Tobacco, BP, and then Royal Dutch Shell, both the Class A and the Class B shares. If we break down the FTSE 100 list and some of those top companies we just mentioned, it actually breaks down to only a small number of industries. So let's break this down now and see what we make of it. So in the FTSE 100, around 20% of companies are actually made up in the financial services sector, and then a further 20% in these other 2 areas, such as industrials and consumer discretionary. So in just those 3 sectors, that's nearly 60% of the entire market. So that's very heavily concentrated in those 3. Adding just 2 more sectors in gets us to nearly 80% of that entire market. So just straight off the bat, we've noticed that the FTSE 100 isn't a particularly well-balanced portfolio. It wouldn't be something I'd probably own in its entirety, and I'd really want a bit more exposure to some other global markets around the world, because it was heavily concentrated in just a few set of sectors. So just one thing to be aware of. And interestingly, if we take a look at this index as a whole and the 12 sectors that are featured on it, and only 4 of those sectors has actually outperformed the FTSE 100 average over the last 5 years, which is quite interesting in itself. So you can imagine how difficult it would be to bet on individual stocks, and you're probably better off owning the index, but that's a whole nother story. So one of the questions that we need to ask ourselves is, in those categories and in those different sections of companies, which ones are potentially going to outperform the market in the future moving forward? Well, nobody has the answer for that, but it's just one thing to be aware of and think about things from a global perspective. And now that we've got some of the high level figures and some of the high level stuff broken down for the FTSE 100, let's take a look at some of the advantages and some of the best bits about this index. Firstly, the FTSE 100 contains some great dividend paying companies. The average dividend payout for the FTSE 100 tends to be around 4% or just sits underneath 4%, which if we compare that to our American cousins in the US with the S&P 500, that's nearly twice as much payout for our dividend income. So if you're someone who might be slightly older or you just want to create a dividend paying or an income producing portfolio, the FTSE 100 has some great stocks inside of it, so make sure you do all of your own research but definitely give this index a check rather than sticking with your native stocks, for example, if you're from the US. You'll find plenty of dividend growth companies on this list, and most importantly, you'll find ones that have consistently paid their dividend and increased it year after year. Very similar to the Dividend Aristocrat and Dividend Kings list. Do your research and you'll find there's some great companies that have paid consistent dividend income. Secondly, there's some great household names on this list which have been around for a really, really long time and aren't going anywhere. If we just grab two examples from the list, we've got Diageo and Unilever. Even if you hadn't heard of Diageo before, they own 200 different brands of alcoholic drinks, which even if you're teetotal, you would have heard about. We're talking about brands like Johnny Walker, Smirnoff, and even Guinness. Yep, even Guinness. And then from a Unilever standpoint, this giant's even bigger with over 400 brands. And again, even if you hadn't heard of the word Unilever or the company Unilever, you would have heard of some of these major brands that they've acquired and bought along the way. Everything from Ben & Jerry's ice creams, Lynx and Axe deodorants, depending on what side of the pond you're on, and then also, love it or hate it, even Hellmann's mayonnaise, all owned by Unilever. So the next time you go grocery shopping, just remember that a little bit of your money is going into the pockets of these big giants, so they could be a good place to put some of your money. And I bet if you checked your cupboards now, I'm sure you've got some Unilever products in there, and you may even have some Diageo ones as well. Number 3, and this is heavily linked to number 2, because these companies are big, large, international companies, they don't actually rely on the UK to generate a lot of their income. So a lot of their income is actually generated from outside of the UK, which can be a good or a bad thing, but we'll spin it as a good thing for the time being. And the positive side will be that regardless of what happens on the UK market from a national perspective, if customers in Asia or customers in the US are buying these brands, then that might be a good way to weather the storms of those ups and downs, regardless of what's going on here at home. And in number 4, something that a subscriber recently commented on one of my videos and got me thinking really, that the FTSE 100 doesn't get a huge amount of love, and whether that be on TV or finance shows or whether it be on YouTube itself, having less exposure to those markets means potentially that people pay less attention to it. And although of course the FTSE 100 might not be as exciting as the S&P 500 and doesn't have big names like Tesla, Amazon, Apple, Facebook, Google, and all those other amazing crazy growth tech stocks, the FTSE 100 still has some great companies in it, and they might be from more legacy industries and not as exciting, but as some famous investors have previously noted, and Peter Lynch himself, he loves boring companies that just consistently do a great job and keep selling even throughout economic downturns are quite good investments, so just be aware of that. Anyway, now that we've noted some of the positives, let's have a quick look at some of the negatives and criticisms of this market and this index to see if this is a good place to invest. In number 1, and we can't get away from this I'm afraid, the FTSE 100 growth as a whole has been pretty poor overall. When we compare this to other indexes, especially the S&P 500, the growth over 3-5 years hasn't been particularly exciting. So if you're looking to grow your wealth heavily and had all of your money focused in the UK, I think you'd be pretty annoyed right now. And that would even if we took into account dividends, and don't forget dividends aren't really reflected in the growth. There is some growth there with dividend being paid, but just be aware of that, worth noting. Secondly, and this is a bit of a weird one, but in the UK there's almost no exposure on the FTSE 100 to kind of high growth software and high growth technology stocks. And I guess really if we look at global markets, this is where a lot of the growth has been over the last 5 and 10 years. Again, going back to those FANG stocks in the US, we think about Tesla, Apple, Google, and Amazon, etc. There isn't really a comparable one on the FTSE 100. Other than companies like Sage, who I can think of off the top of my head, who make accounting software and are quite globally well known. There are other ones who have been on the list previously, but don't feature anymore because they've been bought by private equity. So companies like Sophos, for example, one of the companies I used to work in my sector in cybersecurity, they were bought by a private equity firm, unfortunately. So you can't get much exposure on this index to those sectors. UK firms tend to either get bought out by private equity like we just mentioned in Sophos, or they just tend to get bought out by another big company again. So ARM, for example, that Cambridge-based processor company got bought out by Nvidia recently. So us investors don't even get a chance to buy them on the stock market. FTSE 100, big tech, just seems to get bought by everyone else. My third point is about currency issues being a bit of a risk. So although we might want to have a bit of bias because we're spending our money in pounds and we can buy these stocks in pounds, as I mentioned before, they actually own a huge part of their income externally, internationally, and nearly 70% of their income and profits is generated in either China or dollars, etc. And all this means really is the price of the stock is heavily influenced by those exchange rates. And if you think back to the political instability of the years like 2016, for example, as the pound weakened against the dollar, prices on the FTSE 100 actually go up because their profits technically generate more money once they convert them back into pounds. However, If it goes the other way, things might not be such a good investment. And leading on from number 3, number 4, there's too much uncertainty around the B word. Brexit is still causing a huge number of issues, and really all of that comes down to uncertainty. And as we know, businesses hate uncertainty, not knowing what's going to happen potentially with different regulations, especially in large sectors of the economy like financial services, for example. Nobody really knows what's going to happen, so there's probably lots of money not only on the sidelines of this index, but also have decided to readdress their funds and send them elsewhere. So potential bargains maybe, we just don't know what's going to happen in the future. And number 5, it might be a little bit too harsh, but I've said lack of high growth stocks. So we've still had some really good performers and really nice standout ones over the last 5 years, but some of these companies for me feel like they've kind of reached their peak of growth, and I really struggle to see where their potential future might be. But again, just my opinion. And if we take the example of the best growing stock per percentage over the last 5 years was actually Ocado. So if you're from the US or UK and you haven't heard of them before, they're an online grocery retailer. So effectively they've done really, really well during the pandemic when everyone's been at home and wanted their groceries delivered. And of course this area does have high potential, but they're not exactly like a big giant, and potentially they're not really going to go global. And if we think about this market, it's highly competitive and the profit margins are extremely low. So I'll be really interested to see, and I wish them really, really good luck about growing, but it does concern me and think it doesn't really inspire me that the FTSE 100 index has anything really exciting going for it right now. And if we take a couple of more examples, we've got a couple of more interesting ones. JD Sports has been a great returner on investment and they've done extremely well, and I wish them more and more good luck. These guys are a retailer who sell both online and bricks and mortar, and that's all your activewear and sports brands like Nike, Adidas, etc. But again, it's trying to work out, can you grow over the next 5-10 years? Can you expand internationally and those kind of things? But who knows, do your research into these ones, it might be a good one to invest in. And then finally, one of the biggest growers was actually Scottish Mortgage Investment Trust. These guys have been in the news recently because, kind of like ARK Invest, they put a lot of their big bets on last year in companies like Tesla, Shopify, Square, etc. And there'll be many others that I've completely forgot off the top of my head, but they focus a lot on those heavy growth stocks, which have done absolutely monstrous returns over the past 18 months, a couple of years, and have led them into having quite a strong position now. But again, because we don't know where the next set of growth is going to come from, it's quite interesting that a mortgage investment trust is one of the biggest returning stocks on the UK index. Pretty weird, isn't it? Alright, so outside of the pros and cons, what other things should we consider? And here's my summary and a few thoughts and opinions just to get a bit of a conversation started. But do let me know in the comment section below. Genuinely, I'd love to hear your thoughts. Pause the video now, do whatever you need to do. Let me know what you think about the FTSE 100. Firstly, when I was writing this video, I was thinking about how much my portfolio and potentially your portfolio is weighted to the UK. Remember what I mentioned earlier, the UK market is actually about 4% of the global market. So I know a lot of these robo-investing platforms and lots of other strategy funds, for example, like the Vanguard Life Strategy Fund, is actually biased and home biased to the UK. And they typically tend to put around 20% of that fund in the UK market, even though it's only really worth about 4% of the global market. Now, of course, as no one knows where future growth is going to come from, it's no good saying that whether that's overweighted or underweighted, but we do know that it's overweighted according to its current position. Whether it's going to be overweighted in the future, who knows? But again, in my opinion, I'd probably want to keep it around that 4 and 5% exposure just because there's too much uncertainty around it at the moment. Secondly, on my final point, and again, one of the advantages we mentioned earlier, I think there's some fantastic companies in here, some real hidden gems, and especially the high dividend paying ones can also grow as well. So you've got that double whammy of high growth, high dividend, which may not last forever, but you can certainly enjoy it and certainly make the most of it if you're looking for an investment producing portfolio. Think about companies like Legal & General, Rio Tinto and AstraZeneca, for example, all very much long established, income producing, dividend giving stocks. And for me personally, I do have a bit of skin in the game. When I originally built out my portfolio and I was playing around with some dividend stocks, I was trying to start out and build a whole dividend growth portfolio. I've since shifted and trying to grow a bit more of the growth side, but I do own companies like Evraz, Legal & General, and I've held companies like the Phoenix Group before, which have provided really good stable income and stable dividends, which I would personally reinvest, but if you needed that income, then you've got a good choice there. But overall, in my opinion, with my portfolio, I wouldn't want to concentrate too much on the FTSE 100. Personally, I want to have a globally diversified portfolio, not put too many of my eggs in one basket, and really, because of my age and because of my current position, I'm going for long-term growth, and I'm happy to be just consistent with how much I put into the market. Make sure I consistently invest month by month is probably my biggest focus, rather than worrying about specific industries and specific countries. So is the FTSE 100 a good market to invest in? Overall, yeah, sure, it could be. Everything again depends on your current position though. I think there's lots of hidden gems in this index. I think there's some great dividend paying stocks and also some great growth potential, but of course, nothing too exciting. Might be a little bit boring for some people, but boring might be good. I think any great investor is going to want to have some exposure to the UK market because it does punch above its weight and there are lots of good companies on the list. Anyway, I'd love to be a fly on the wall and see how the market performs over the next 5 to 10 years. If I do get a time machine, I will let you know and I will come back and update this video. But for now, let's see where it goes. So thank you so much for making it to the end. If you found the video useful and found it quite interesting, or I've missed out on anything or any criticisms at all, please let me know in the comments below. Should I do more of these videos? Should I give my analysis on different markets around the world? Do you think the FTSE 100 gets enough love, for example? Are there any individual companies that you think might be worth looking at, for example? Let me know in the comments below and I'll be sure to respond and have a look. Anyway, if you found the video useful, please drop me a like, guys, subscribe for more, and I'll see you in the next one.